Welcome to our channel, Stock Market Analyst. Today, we're diving into the key differences between active and passive investing. By the end of this video, you'll have a clear understanding of what these investment strategies are, how they work, and which one might be right for you. Don't forget to like, subscribe, and hit the bell icon for more investing tips. What is active investing? Let's start with active investing. Active investing is a strategy where investors or fund managers actively make decisions about buying and selling stocks or other assets. The goal is to outperform the market by taking advantage of short-term price fluctuations and market trends. Active investors use various techniques, such as fundamental analysis, technical analysis, and market timing, to make informed decisions. What is passive investing? Now, let's move on to passive investing. Passive investing is a strategy where investors aim to replicate the performance of a specific market index, such as the S&P 500 or Nasdaq 100. Instead of trying to beat the market, passive investors focus on long-term growth by holding a diversified portfolio of assets. This strategy involves less frequent trading and lower management fees compared to active investing. Key differences between active and passive investing. Now that we know what active and passive investing are, let's compare them side by side. 1. Management style. Active investing involves frequent buying and selling of assets based on market analysis and trends. Passive investing involves holding a diversified portfolio that replicates a market index with minimal trading. 2. Goal active investing aims to outperform the market by taking advantage of short-term price movements. Passive investing aims to match the performance of a specific market index over the long term. 3. Cost. Active investing typically has higher management fees and trading costs due to frequent trading and active management. Passive investing typically has lower management fees and trading costs due to less frequent trading and a buy and hold approach. 4. Risk. Active investing can be riskier due to the potential for poor investment decisions and market volatility. Passive investing generally considered less risky due to diversification and a long-term focus. 5. Performance. Active investing performance can vary widely depending on the skill of the investor or fund manager. Passive investing performance closely tracks the performance of the chosen market index. Benefits of active investing. Active investing offers several benefits. 1. Potential for higher returns. Skilled active investors can potentially achieve higher returns by taking advantage of market inefficiencies and short-term price movements. 2. Flexibility. Active investors have the flexibility to adjust their portfolios based on market conditions, economic trends, and individual stock performance. 3. Opportunities in niche markets. Active investing allows investors to explore niche markets and sectors that may not be included in broad market indices. Benefits of passive investing. Passive investing also offers several benefits. 1. Lower costs. Passive investing typically has lower management fees and trading costs, which can improve overall returns over time. 2. Simplicity. Passive investing is straightforward and requires less time and effort compared to active investing. Investors can simply buy and hold a diversified portfolio that tracks a market index. 3. Consistent performance. Passive investing aims to match the performance of a market index, providing consistent returns that reflect the overall market. Which one should you choose? So, which investment strategy should you choose? It depends on your financial goals, risk tolerance, and investment preferences. 1. Investment goals. If you're looking for higher returns and are comfortable with taking on more risk, active investing might be right for you. If you prefer a more hands-off approach with consistent returns, passive investing could be a better fit. 2. Risk tolerance. Active investing can be riskier due to market volatility and the potential for poor investment decisions. Passive investing is generally considered less risky due to diversification and a long-term focus. 3. Time and effort. Active investing requires more time, effort, and expertise to analyze markets and make informed decisions. Passive investing is simpler and requires less time and effort, making it ideal for investors who prefer a hands-off approach. Practical example. Let's look at a practical example. Here's a comparison of two investment strategies. 1. Active investing. An investor actively manages a portfolio by buying and selling individual stocks based on market analysis. They aim to outperform the market by taking advantage of short-term price movements. 2. Passive investing. An investor buys shares of an index fund that tracks the S&P 500. They hold the fund for the long term, aiming to match the performance of the overall market. By understanding the differences between these strategies, you can decide which one aligns with your investment goals and preferences. To sum up, active and passive investing are two distinct strategies with their own advantages and risks. Active investing involves frequent trading and aims to outperform the market, while passive investing focuses on long-term growth by replicating a market index. By understanding these key differences, you can make more informed decisions about which investment strategy is right for you. That's a wrap on our guide to the difference between active and passive investing. If you found this video helpful, please give it a thumbs up, subscribe to our channel, and share it with your friends. Have any questions or topics you'd like us to cover? Drop them in the comments below. Happy investing!